Hi, MSL here. So in this video, I want to put together perhaps your most useful resource on group accounting you'd find on YouTube today. Now, before we continue the question, I have put together this very useful resource. It's roughly 24 pages. It has all the key templates that you'd need. So I'll place a link to this in the comments. It will be a pinned comment, right? Just download it. It's for free. And I hope this helps you understand further. Let's continue the question now. So this video will be for anyone preparing for a financial reporting exam, a corporate reporting exam, or the strategic business reporting exam of the ACCA, any professional exam. If you are at the university taking an undergraduate program or a master's program and you're doing some form of group accounting, you still find some value from this video. Before we start, you can go into the comments and then let me know where you're watching from. So if you're watching from somewhere in Ghana, you can just say I'm from where you are in Ghana. If you happen to be outside Ghana, you come across this video on YouTube, you can let me know where you're watching from. So just go to the comments and say watching from, and you add where you're watching from, right? Just to kind of gauge where you are tuning in from. So in this video, like I said, it's on group accounting. I'm going to use this question. It's going to be a long one, but I want to guarantee you that by the time we are done, you have a very, 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 very good understanding of how to prepare group accounts. It's a very easy area once you understand the fundamentals. So this question, although may be slightly complicated in terms of how it looks, I'm going to make it easy for you to understand. So here, we've got 4 entities, it looks like, on the face of the financial position statement. We've got MSL Holdings PLC, we've got Alpha Limited, we've got Beta Limited, and we've got Gamma Limited. Who are they? We'll find out quite soon. Then we go to the requirement. It's quite lengthy. I made sure it has all the basic, crucial things you must know how to account for in an exam. So apart from that, I'm going to show us the core entity types. So we've got a parent, of course, in this question. We've got a subsidiary. We've got an associate. We've got a joint venture. And then we've got a joint operation, all right? Just to kind of let you know what we have here. Now, do not run away yet. Those of you who are doing basic financial reporting, I know you may not be required to know how to account for joint ventures, joint operations, but the basic mechanics, very important. And it's to also let you know that, well, if you can tackle this, you should be able to build on this as a foundation, right? So let's go to our requirement. What does this say? It says we should prepare the consolidated statement of financial position for the MSL Holdings Group as at 31st December 25, right? So this is what we are asked to do. Prepare the console SFP, CSFP, right? Okay. It's a very mechanical exercise. When I say mechanical, it has a lot of steps involved. So from working 1, we go to working 2, we go to working 3, we go to working 4, right? In that order. It is not difficult, trust me. If you can do this one, what we're going to do here, you can attempt pretty much anything the examiner will throw at you. So I'm going to go through the question with you. In the course of doing the question, I'm going to teach the concepts, right? So like I said, it'll probably be a long video, but I want to make it your most useful resource on this subject matter on the internet, right? So let's do it together. So we're going to start from the beginning. It says, so MSL Holdings PLC is a publicly listed parent company of a rapidly expanding diversified group. Okay. You're the group financial controller. You've been tasked with preparing the console SFP as at December 25. The draft standalone SFP for MSL Holdings PLC, Alpha Limited, Beta Limited, and Gamma Limited at December 25 have been presented below, right? So we've got 4 balance sheets, kind of. If you run through quickly, you've got the PPE line, that's property, plant, and equipment. We've got investments. As you can see, it's just the parent that has got that figure under their line. Then you have your current assets. So you've got your inventory, your receivables, and then your cash and cash equivalents, right? Standard balance sheet stuff. Then under equity, of course, you've got your share capital, you've got your retained earnings. Then under our non-current liabilities, we've got our long-term borrowings. Under current liabilities, we've got trade and other payables as well. So like standard balance sheet stuff, right? Nothing scary. Now we're going to go through the notes, and through the notes, I'm going to explain certain important things to you. Okay. So note 1 says, let's look at the investment in Alpha Limited. What's happening here? Now, on 1st Jan 23, MSL Holdings acquired 80% of the equity share capital of Alpha Limited. So hold on a second. I'm going to use this opportunity to explain to you basic categories that we've got in group accounting, right? So let's come here. At its core, I'm going to create a little timeline for you, okay? So let's do something like this. This is 100%. This is 0%. Somewhere in the middle here, we've got 50%, right? So if you own greater than 50%, if you have more than 50% of an entity in terms of their voting power, ordinary share capital, you are said to have control over that entity. And then you are going to do full consolidation. So this gives you what we call a subsidiary, right? So this is like a basic revision. Hopefully you should know this from your class. But yeah, quick revision. Once you've got 50% or more of the shares of an entity, you control that entity, and then you treat them as a subsidiary where you're going to consolidate them fully. Now, control comes about as a result of having power over the entity, exposure, right, to the entity, and then having the ability to use that power to what? Affect the level of the exposure you have. But yeah, that is like the theory aspect of it. But yeah, basically 50% or more. Let me just change this. We say you have got control, and that is a subsidiary, right? Okay, now I'm going to create a new barrier. Somewhere around here, we'll have 20%. Now, if you own between 20 and 50, right? So between 20% to 50, what we say is you do not have control. What you have is known as significant influence. So this time you've got significant influence, right? Now, significant influence here is going to create an entity type called an associate. We do not consolidate associates. Associates are accounted for as a one-line item on the face of the financial position statement under your non-current assets. We'll call them investment in associates. Are we good? All right. Now, if you own less than 20%, so anything from 19 downwards or less than 20 to all the way 0%, you have an ordinary investment. So this will be a financial instrument, and you're going to account for that under the relevant financial instrument standards, right? So that's your IAS 32, IFRS 9, right? But it doesn't end here. We've got an entity called a joint venture, okay? So we'll come to that, right? There's a joint venture and there's a joint operation. I want to use this first part to clear that part so that when we get there, we just move on quickly. Now, there is a standard called IFRS 11. IFRS 11 deals with joint arrangements. There are fundamentally two main types of joint arrangements. We've got a joint venture and we've got a joint operation. Now, here's a key difference. When it comes to a joint venture, to summarize it for you, a separate entity is formed and the joint venturers or the entities have a stake in that separate entity. I'll take it again. In a joint venture, if company A and company B come together to form a joint venture, they form a third company C, and A and B will have shares in company C. So there will be joint control. Joint control over the net assets of another entity, right? Okay. So usually joint control can be when you have exactly 50%. It's possible that like, the question tells you company A and company B have 50-50 of a third entity. Please remember, it's more likely going to be a joint venture than a subsidiary because you don't have more than 50%, right? Okay. So just, again, this is like a summary of the whole thing, right? So joint control over the net assets of another entity. But let me make your life very easy. And this is why I think you get the value from this session. A joint venture and an associate are accounted for in the same way. That's why I said, those of you doing financial reporting, before you say, oh, this probably looks scary, do not run away yet. It's a very easy concept. I'll make your life easy, right? So an associate and a joint venture, guess what? They are accounted for the same way because when you go to IAS 28, IAS 28 is investment in associates and joint ventures. It recommends a method called the equity accounting method or the equity method, right? Which I'm going to use in this question. So the equity accounting method under IAS 28 is the same we are using for an associate and the same for a joint venture. So my point is, if you can account for an associate, then automatically you can account for a joint venture. And if you recall what I said an associate is not consolidated. Do not fully consolidate the result of an associate. You use the equity accounting method to find a one-line item called investment in associate and place that under the non-current assets on the statement of financial position. It's the same for a joint venture. We will never, ever, ever consolidate a joint venture's financial statements fully. We'll also do the same equity accounting method for that joint venture and then have a one-line item under non-current assets called investment in joint venture. Are we good? So once you can do associate, you can do joint venture. Stripping away all the complexity, this is it. Now, a joint operation is quite different. For a joint operation, there is no separate entity formed, right? There is no separate entity. Meaning that entity A and entity B can come together, pull their resources together, and do a certain project. Now, if that project ends up being accounted for as a joint operation, there's no third entity. So there's no net assets, and there's nothing like, let's go and take our share of net assets. What happens in a joint operation is that the operators have their share of any assets, any liabilities, any revenue, any expenses. So if a question tells you you entered into a joint operation with somebody and you have 30% of that joint operation, you take 30% of the joint operations assets, add it to your assets. 30% of the joint operations liabilities added to yours. 30% of the joint operations revenue added to your revenue. Same for the expenses. Meaning that you do proportionate consolidation. In effect, technically. In other words, for a joint operation, see it like how you account for a partnership in basic accounting. Two partners come together and they have a share of partnership, what profit or loss, partnership assets, liabilities, everything, right? That is the same concept here in summary, in principle, right? So this is it at a very basic level. I know it's overly simplified, but it is so that even if you're a beginner, you have somewhere to start from, and so that the terms do not look scary to you, right? Okay, so let's go back to our question. So we are told here that MSL Holdings acquired 80%. Now you are all experts in consolidation. Remember I said if you own more than 50%, yeah, you've got control and that gives you a subsidiary. Easy, innit? So that means we have 80% is greater than 50%. Therefore, Alpha Limited is a subsidiary. Simple. So we just come on top of here and we say Alpha Limited is an 80% SUB. SUB means they are a subsidiary, right? That is what I mean. So 80% subsidiary, quite easy. All right, we're good with that. would look at the other ones later. At this date, retained earnings of Alpha Limited were 20 million. So I want to show you standard language using consolidations, right? So usually I'll prepare what we call the net assets, and you see what I mean. On 1st Jan 23, this is the acquisition date. Okay, that is the date the parent bought shares in the subsidiary. That's what it means, right? Okay, so they said at this date. Which date? They are referring to this date as said here. Yeah, refers to 1st Jan 23, meaning the retained earnings figure of 20 million is the acquisition date retained earnings. Then consideration consisted of 4 elements. So consideration is how much the parent offered to buy the subsidiary, right? The immediate cash payment of 20 million Ghana cedis. This is the only element currently recorded in MSL's investment line. Okay, great. So this is called cash consideration. Is the most straightforward to account for. They offered cash of 20 million to buy, and that's simple, right? Second one is MSL Holdings issued 1 new share for every 3 acquired shares in Alpha Limited. This is called a share for share exchange. Share for share exchange, right? The market value of an MSL Holdings share on 1st Jan 23, which is acquisition date, was 5 Ghana cedis. MSL has not recorded this share issue, right? So 1 new share for every 3. I'll show you how to account for that. Then a cash payment of 13.31 million payable on 31st December 2025, which don't forget is our current year end. And don't forget they acquired them on 1st Jan 23. Okay. All right. So they promised them on 1st Jan 23 that on December 25, that is exactly 3 years after acquisition, they're going to pay them 13.31. This is called a deferred consideration. Deferred because you want to pay them the amount of money, but you pay them at a future date. So it's deferred to the future, right? The treatment for deferred consideration is that we discount from future value to present value, and then we add that present value as consideration. Again, I'll show you how to do it. But there's one extra layer of complexity that many students forget. In accounting, whenever you discount a future value figure to present value, you have distorted the mechanics. Time value of money must be respected. So there's something called unwinding. Okay. This is the logic, right? And I'll demonstrate that again when we get here. If you have this is present value today, this is future value. If you take any figure from this date and you bring it to this point, any year 1, year 2, and year 3, any year that you get closer to the future value date, you must unwind, which means take the present value figure and simply multiply it by the discount rate or the interest rate to grow it by 1 extra accounting period, such that the time value of money principle is always respected. This is the principle. So don't forget, anytime you discount, write it somewhere that I've got to do some unwinding. Check the time, right? But yeah, basically. So MSL's cost of capital, we are told, is 10%. And we are told also that they have not recorded this liability or any finance cost, and the payment is also pending. The payment is pending. All right. So this is the information we have. We'll work on that. Then a further payment dependent on Alpha's future profit target. Anytime you see a payment that will be made dependent on something happening in future, or if they say an extra payment will be made if something occurs, it is called a contingent consideration. Contingent consideration because it is dependent on what will happen in future or what may happen in future, which means it is contingent on, dependent on, based on, something happening in future. So contingent consideration must be recorded at its fair value. Okay. So the fair value at acquisition date was 4 million. By December 25, the fair value was reliably reassessed to be 5 million. I'll show you how to account for it. Remember, At acquisition date, you must include the contingent consideration at its fair value, but please check by reporting date if that fair value has changed, because you've got to account for that. So this gives us the structure, and these are the four most popular ways you can acquire. And of course, the other ones like you can transfer land to buy the subsidiary, right? But yeah, like I said, this is a foundation to build on. Once you know how to do it based on this question, the world is yours to play with, right? You can do other questions and see how additional elements may be accounted for, right? Okay, so I'll show you what to do when we get to the main workings. At the date of acquisition, a specialized manufacturing plant had a fair value of 6 million above its carrying amount. This is called a fair value adjustment. Fair value adjustment. Just see it like a revaluation at a very fundamental level. And I'll explain why it exists. The principle is if you are doing consolidation, your figures used must all be at fair value. So if there's any figure in the entity you are buying which is not at fair value, we have to revalue to fair value and then account for the fair value impact, right? So they are saying there's a specialized manufacturing plant, fair value 6 million, more than its carrying value. This is in excess, right? It's got a remaining useful life of 5 years. It's a plant. If we have not held it at fair value, it means we have depreciated at a lower figure. We must calculate that depreciation they have not been charging. That's why they gave us a 5-year useful life, right? Okay, the group policy is to value or measure NCI at fair value. Fair value of the 20% NCI. Why 20%? Because this is 80%. Now, let me explain what NCI is quickly. You see, if I said you have control, yeah, that's a key word, your control. If you control 80%, then do you agree that there is 20% that you do not control? The part you do not control is called non-controlling interest, shortened as NCI. Okay, so the 80% is your controlling interest, then your 20% or whatever the magic number will be your non-controlling interest. So let's say the question had said, this was instead, let's say 60%. Then our NCI would have been what? 40%, right? It must always add up to 100. Remember that, okay? All right, so here we are told that NCI is 20% and they are using fair value. There is an alternative method. So instead of fair value, the question could have said they use the full goodwill method. So take note, okay? If you see full goodwill method in the question, it's the same as NCI at fair value. Now, there's another way we can do it, very popular as well, which is the proportion of net assets method. The proportion of net assets method. When I get to the NCI side of things, I'll show you how that would have looked like so that you know what to do if the question had changed this sentence to just that, right? So fair value of the 20% NCI was 12 million. Goodwill in Alpha Limited was impaired by 10% in 2024, and a further 10% impairment charge is required for year ended December 25. So I'll show you how to account for impairment of goodwill, both under the full goodwill method and the proportion of net assets method. I'll talk about that shortly, don't worry. Note 2, investment in Beta Limited. On 1st Jan 24, MSL Holdings acquired 30% of Beta Limited. Hold on a second. Remember I said if you have between 20 and 50, which falls here, 30% falls between 20 and 50. You have significant influence and that makes the entity an associate, right? What that means is that Beta Limited is an associate. And I said associates are not consolidated, if you remember, right? So we're going to do the equity accounting method for this entity. Don't forget. So Beta Limited, let's label it here. They are a 30% associate. Are we good? Let's proceed. What do they say about them? We bought them for 14 million. This is basically the purchase consideration, right? At that date, that is acquisition date, Beta's retained earnings were 15 million. During late 2025, Beta sold goods to MSL. So Beta is associate. MSL Holdings is the parent. So here, associate sold goods to parent. There's something called provision for unrealized profit. I'll show you how to account for it, right? So Beta Limited sold goods, associate sold to parent. for 4 million Ghana cedis at a markup on cost of 25%. MSL Holdings still holds 50% of these goods and inventory at the year end. So I'll show you what to do here. The key thing here is provision for realized profit, right? Provision for unrealized profit. Okay. Then our third note, investment in Gamma Limited. So on 1st July 25, please do not forget we are in December 25. So 1st July 25 is roughly 6 months till year end, okay? Or 6 months into the current year. MSL Holdings acquired 50% on the dot. Interesting, right? Of the voting shares in Gamma Limited for cash of 10 million as a consideration. The contractual agreement explicitly stipulates that all decisions regarding the relevant activities require the unanimous consent of MSL Holdings and the other 50% shareholder. This is evidence of joint control. Everything they want to make, every decision, requires unanimous consent of MSL and the other shareholder. I mean, if one person agrees and the other does not agree, the thing will not go through. Unanimous consent, right? So that is what this essentially means here. Okay, so that gives us evidence that Gamma is a 50%. We have what? A joint venture. Remember, I give you the characterization here, right? So you have joint control, 50% on the dot. So this guy here is a 50% joint venture. Okay, so far the picture looks clear. There's a parent that is MSL Holdings. We've got an 80% subsidiary Alpha Limited, 30% associate Beta Limited, 50% joint venture Gamma Limited. We good? All right. Then who's next? Okay, the legal structure ensures the investors have rights only to a share of the net assets of the arrangement. Gamma Limited reported a profit after tax of 6 million for the full year end December 25, which accrued evenly throughout the year. This is just evidence that we can apportion by 6/12. It accrues evenly, right? MSL has not yet accounted for its share of Gamma's profit. Not bad. Then note 4, joint operation Delta Pipeline. On 1st Jan 25, start of this year, MSL Holdings entered into a joint operation contributing 5 million cedis in cash, currently unallocated, right, in their investment. They're entitled to 40% of the asset revenues and liabilities. This is evidence that it's a joint operation, okay? At 31st December 25, the Delta Pipeline, that is a project, has total balances, PPE, of 25 million, inventory 5 million, trade payables 17.5 million. For a joint operation, like I said, you take your share of asset, liabilities, revenue, expense, and add it to yours in your books. No consolidation. So even if, I could have done that. I could have created a whole balance sheet, right? But it's a project, not an entity, you see. So you'll be given most of the time information in the notes for the joint operation. Remember to take your share of assets, liabilities, revenue, expenses, and all of that, right? So here we've got a 40% joint operation. %40 joint operation. All right. Then we've got some intra-group trading. During 2025, Alpha Limited sold components to MSL Holdings, right? So who is Alpha? So we've seen Beta is the associate, eh? Okay, nice one. So Beta associate has sold to parent, which is impressive. Then we are also told over here that Alpha Limited, Alpha is the subsidiary, okay? The subsidiary also sold to the parent, right? The subsidiary also sold them. So Alpha sold components to MSL Holdings for 5 million cedis. For 5 million cedis, right? Okay. Applying a profit margin of 20%. Profit margin of 20%. Okay. Then MSL Holdings still holds 40% of these components in inventory. 40% of the components in inventory implies what we are calling what? The unrealized profit. Okay, the provision for unrealized profit. All right. Alpha Limited's trade receivables include 1.5 million due from MSL. So that is what we call intra-group trading or intra-group transactions or balances. Okay. There's a basic principle in group accounting. All intra-group balances must be eliminated. All intra-group balances must be eliminated. Remember that. Okay. However, MSL's trade payables only show 1 million due to Alpha. The difference is due to a cash payment of 500,000 initiated by MSL on 3rd December 25, which Alpha received on 3rd January 26. This is called cash in transit. Okay. So they sent some cash. It never got to them until a later period. So we're supposed to also look at how to account for cash in transit. So this is our question. We're going to go through the notes carefully, like we have done, and then we try to account for it. Now, I'm going to give you a skeleton or a structure to use. In consolidations, let this be your approach. It doesn't fail. Even at the advanced level, you are doing complex group step acquisitions, step disposals, and full disposals, vertical groups, D-shaped and complex groups, all of those right. So let's look at your first working most of the time is to do your group structure. So you're going to show how the group looks like. Your second working most of the time, you can do your net assets together with any consolidation adjustment you may have, right? Then your third, standard or going by the standard, you must come and work for your goodwill. Working for, you work for your NCI, your non-controlling interest. Then in a question like this, standard would have been working 5 should be the parent retained earnings. But because we have other entities, you can do your working 5 here to be the investment in associate. In associate. Working 6, you do your investment in joint venture, JV. Then you can come and do your working 7, which is the consolidated retained earnings of the parent, right? These are your standard workings. Pretty much that is how it's going to look like. So we're going to go through the question step by step, and then we'll figure everything out, okay? Okay, so let's continue. We're going to look at the financial position statement, like I said. And there are some standard workings. So I showed you here. Group structure, net assets, goodwill, NCI, and all of that, right? Okay, so for a question like this, let's go through the motion. So your first working, always write the name of the group, right? So the name of the group in this question is MSL Holdings Group, right? Okay, then you start with your workings. Your first one is, like I said, your group structure. Here you just show how the group looks like. So your working 1, don't forget this, is your group structure, okay? It is basically a visual representation of what you have in front of you. So here we have MSL Holdings. They've got one subsidiary, one associate, and a joint venture, kind of, right? Okay, so we can just use this representation. We can just do this. We can do this, and we can do that kind of, right? So they have got, the first one is alpha. Then we've got beta. Then we've got gamma, right? Again, don't forget 80% sub, 30% associate, 50% joint venture. Okay. So this guy, alpha, is, we have 80%. So this is an 80% subsidiary. Beta, 30% associate. Then gamma is a 50% joint venture. Okay. So one thing you should also always do is to write the dates of acquisition. So this one was acquired on 1st January 2023. It helps you when you are doing your post-acquisition movements. This guy was bought on 1st Jan 2024. And if you remember, this guy was mid-year. So that was 1st July 2025. Right. Very important regarding the dates. Okay. Of course, the joint operation, you don't show them technically, right? Because they are not an entity per se. But you can just make a little note here that MSL Holdings also has a 40% share of a joint operation. Okay, this is done for the sake of completeness. All right. Okay, so that's about it. Do not forget that 80% subsidiary implies that here your non-controlling interest NCI must be 20%. Okay. All right. So once we have this, before we go to our net assets working two, we can do our key workings for, remember the consideration, we have share exchange or share for share exchange. We've got deferred consideration, and then we've got contingent consideration, right? So we can work for those guys here. So we can say consideration, or let's say purchase consideration workings. The first one we have to work for is the share exchange, or some will say share for share exchange. So we are told that here, MSL issued one new share for every 3 acquired in Alpha. So for every 3 shares Alpha has, MSL will give them 1 new share, technically. You understand? For every 3 shares Alpha has, MSL will give them 1 share. Okay. So if you check, let's come here. This is the balance sheet. Watch it carefully. If you look here, we have got Alpha over here. Okay. This is Alpha's balance sheet. Alpha has got, if you look at their share capital, 15 million. We are assuming, of course, that they are issued at what, 1 CD per share, unless told otherwise, right? So they've got 15 million shares. You bought 80% of this. Okay. So let's do the math here. So for the share exchange, we'll say, okay, we bought 80% of 15 million, or that's what we are offering to buy, right? I'm using the 15 million from here. Okay. That should give us 12 million if you do the math. Right. Okay. Now we are told that 1 new share for every 3 acquired. Every 3 acquired. So that once you acquire, that's what we found. Not every 3 the company has. For every 3 you bought, you give them 1. Kind of, right? So it means here that we're going to say, okay, for every 3, so I'm going to say, therefore, my new shares will be 12 million. For every 3, I'm going to give you 1, right? So this will end up giving you 4 million new shares. But this is in numbers. We want it in value. We are told in the question that the market value of an MSL holding share on 1st Jan 23 acquisition was 5 cedis. So each share is worth 5 Ghana cedis. So we can say then it means the consideration for shares will be the 4 million shares at what? 5 Ghana cedis per share. 5 by 4 should be 20. So this we have 20 million. So this is the consideration from the share exchange, right? Okay. Because you are going to issue shares, it's going to affect the share capital. Don't forget that. It will affect share capital. When I'm done, I'll do the double entry for you to see how it works. Okay. All right. Then the next one we have got in the question is over here. We can work for the deferred consideration. Remember I said deferred consideration means I'll pay you a certain amount in future with no conditionalities most of the time. So I'm going to discount that from future value to present value. So we are told that you pay 13.31 million on 31st December 2025. So we're going to discount to present value. So this is the first one, share exchange. The next one is my deferred consideration. Okay. What is my deferred consideration going to look like? Now for my deferred consideration, let me do this here. Deferred consideration. All right. So here, we're going to use the present value formula. So present value is essentially a certain future value figure divided by 1 plus a certain rate to the power n number of years. Yeah. So how much did I promise to pay them in future? 13.31 million. So I can say, the question is in thousands, is it? Okay, it's fine. We can truncate everything we've done. So this one is roughly, I'm truncating to 1,000, okay, so that we are consistent. So this is roughly like 20,000. But you get this in 20 million, right? If I truncate everything here. Do you understand? Right. But yeah, in thousands. Okay. So here, the 13 points, where are you? Yeah, 13.31. So this is going to be 13.31 divided by 1 plus, this is 10% to the power how many years? 3 years. You see? Why is it 3 years? Because you bought them 1st January 23, year end is December 25. So the whole of 23 is 1 year, whole of 24 is 2nd year, whole of 25 is 3rd year. Okay. All right. So let's do this here. If you discount this, let me do the math. 1 second. Let me, on my calculator, this should be 13,310 divided by 1 plus 0.1 power 3. I got 10,000 flat. So this will give you 10,000. Okay. So this is your deferred consideration at present value. At present value. However, so this is what we use for the goodwill. Okay. At present value at acquisition date. At acquisition date. Okay. But remember I mentioned something called unwinding, right? So we have to unwind this for 3 years at 10%. Okay. But because we are in the final year itself, it's quite easy to do. If you unwind this, let's do the math. So my unwinding discount or interest is going to be the 10,000, right? For 3 years, 10%. Okay. So we can say, okay, this times, we would have done like 1.10, but power 3. Okay. That's simple. So this to the power 3. Why to the power 3? Because we've done 3 years into it. So if you do this and you subtract the initial 10,000, it should give you a figure of 3,310. If you check the math out, this plus this gives you the full 13,310, which is what you promised to pay them by the end of 25. So you see, we are doing the balance sheet at end of 25. We would have this figure there as the amount to be paid, right? So that is it. If it's a question where you have, let's say, you are accounting for consolidation as at the end of year 1, then you would have done just this to the power 1. Take note of that. Okay. All right. So that is about it for this guy here. Then we'll do the contingent consideration. That is more straightforward. So for our contingent consideration, this is dependent on something happening. They said they will pay them, fair value was 4 million acquisition. They will use that 4 million, but we must reassess to its fair value at year end of 5 million. Okay. So here, initial fair value this is 4 million. This is what we use for our goodwill calculation. Okay. But we are told that our year end value is 5 million. So it has increased by 1 million. So this is a 1 million increase, but this is a loss. You see, you promised to pay somebody 4 million. By the time the time came for you to pay, it has gone to 5 million. You are owing them extra 1 million, right? So this is like a loss. Okay, so a fair value loss. We'll take this to parent retained earnings. Okay, so this goes to console retained earnings. We'll take this to our goodwill working as part of our consideration. Are we good? So remember, deferred consideration, discount it to present value and add it to your goodwill workings. Contingent consideration, use the fair value most of the time, right? It should work in many questions. Okay. So that's about it for the consideration. If you are interested in the double entry, this is how it's going to look like. Let's sum everything up together here. So I'm going to pick this 4 million. Okay. Then I'll pick the 10 million. Then I will pick the 20. Okay. So let's do the math here. In case you're interested in a double entry, I'm going to credit my share capital because I'm going to issue shares to buy them. That'll be 20. Then I will credit my deferred consideration. It's a liability. The balance due at year end is 13. Or we can even do it as at the start of the year, right? So that we can work based on that later. Okay. So we can say, okay, at initial, we had 10,000, which was then unwound. Then we'll credit our contingent consideration. Also a liability with 4,000. When you do the math, this gives you 34. So I'm going to debit your cost of investment for the parent. with a figure of 34, right? So that will be it. Then we'll do the math. I'll show you how to account for the unwinding and all of the other ones. Okay. All right. Then for the unwinding, which is this guy here, right? The double entry is you're going to debit retained earnings of the parent, right? Or finance costs if it's a P&L question with 3310. Then I will credit my deferred consideration with 3310, right? Then, so that is for this guy here. We've done for this too. Then we'll account for the contingent consideration revaluation, this 1 million here. So this one too, we will debit retained earnings of the parent with 1 million. Then I'll go and credit my contingent consideration. These double entries here, they are not necessary, as in the examiner is not going to ask you to. It's just so that this video becomes like your ultimate guide to all of these basics, okay? But remember that the templates are what most students learn and use in the exam anyways, right? Okay, so that is about it. We will come back and do some other magic later. So after you've done all of this, the natural next step is to do your working two. Remember I gave you some guidance here, right? I said working one is your group structure, working two is your net assets, working three goodwill. We'll follow that. So working two is our net assets. Net assets is not difficult at all, okay? So working two is your net assets. Write it somewhere. Net asset is prepared, never for the parent. Never prepared for the parent. If you are learning consolidation, you don't do net assets for the parent. It's done for the subsidiary, the associate, the joint venture. Entities that you have an interest in their net assets is who you prepare net assets for. Agreed. So please don't make the mistake of trying to do net assets for the parent. It won't even work. Okay. So it's prepared for the subsidiary, the associate, and then the joint venture. Now, net assets working has 3 columns. Always. It doesn't change. Okay. So let's do it for Alpha Limited. You open, it has acquisition date. You open reporting date. Then you open post acquisition. It is 3 columns every time. Take note of that. Then we go to the question. Come to the equity side of things. It ends here, right? So you see these lines here, you see they are all reporting date numbers. So it means for the subsidiary, I'll pick 15 as their share capital, 38 as their retained earnings. So I'll say, okay, share capital. And then retained earnings. So this will be 15. And then we have 38. We can open for the other guys as well, but let's finish for this guy. Now, share capital at acquisition will almost always never change in exam, unless the question tells you that maybe the entity issued shares or there was a change in their share capital structure. Most of the time, you put the same figure here. Take notes. Most of the time, this is equal. Okay? All right. Retained earnings will be given to you most of the time in the question, or you work for it. But either way, it's in the question for sure. So look at this one. See here. On 1st Jan 23, MSL Holdings acquired 80% of equity share capital of Alpha Limited. At that date, retained earnings was 20 million. So you put here your 20 million. You see, very easy. Then there will be some transactions that will affect the entity. You must also account for such transactions. Okay. What are these transactions that we have? Now, if you go to the question, we are told that, yeah, there you are, the first one. At acquisition date, there is a plant. Fair value is 6 million above its carrying amount. We call it fair value adjustment, like I said here. So for fair value adjustment, you bring it here. It is the Alpha Limited subsidiary, their net assets. Now we are doing revaluation of a certain asset, right? So I'll bring my fair, it's called a fair value adjustment. This is for the plant. They said it is 6 million, right? So I'll put 6 million here and I'll put 6 million here. It has increased by 6 million and the plant is still there by year end. But the plant is depreciable. It means it's something you can depreciate. Are we good? The plant is something you can depreciate. So we are going to work for that depreciation here. So I'm going to bring, so depreciation of fair value adjustment. That is the plant. Okay. Now, what does this mean for you? Okay. The question will always give you the remaining useful life. The question will give you your remaining useful life. It is your job to use the remaining useful life to calculate your depreciation. And it is not anything complicated. It is not anything complicated. So let's come to the question. They said remaining useful life is 5 years. 5 years. How many years have you had this subsidiary? You bought them when? 1st January 2023. We are in 2025. That is a 3-year post-acquisition period. 3-year post-acquisition period. So our depreciation is going to be, let's do the working here. The 6 million, I can do the working by the side here if we want to. The 6 million divided by 5 years multiplied by 3 years. Do you understand? Because it's a 5-year useful life. You've done 3 years so far. Okay. So we are going to do 6 divided by 5 by 3. This gives me 3,600. You never put your depreciation of fair value at acquisition date. It's always a post-acquisition item. So I'll take this figure. I got 3,600. I'll take the 3,600 from here. Take notes. Okay. I'll take it from here. Some people would want to do the figure of 2,400 and put it here. It's also fine. Okay. But this makes it easy to understand. Okay, I show my fair value adjustment and then I also show my depreciation, right? Then what else happened here? Okay, I think intra-group trading. Alpha Limited also sold to the parent. Now there's a principle. Whoever sells, so in this case, like if the subsidiary sells to the parent, NCI must be affected. If parent sells to the subsidiary, NCI is unaffected. It may sound complex if you're a beginner, but all I'm saying is that here, always check if the subsidiary sells, subtract the provision for unrealized profit from the net assets of the subsidiary. If the parent sells, subtract it from the parent retained earnings working. Write it somewhere if you don't know it or if you're a beginner. If the subsidiary is the one selling to the parent, subtract the provision for unrealized profit from net assets. Just write it down. If parent sells to subsidiary, inventory, subtract the provision for unrealized profit from the parent retained earnings. Okay? So you can do here, sub sells, subtract it from net assets of the sub. If parent sells, you are going to subtract it from parent's retained earnings. Simple. Okay. So here, because Alpha is a subsidiary and Alpha sold to MSL, provision for unrealized profit will come in, right? They said they sold 5 million. profit margin 20%. MSL still has 40% in their inventory. So we're going to say, okay, our next line item here is provision for unrealized profits. This is basically the idea that you are one group. You cannot sell to yourself. The whole idea for group accounting is that we are accounting for the financial statements of different entities as though they are one. So if you guys start treating and doing business, treating yourself as though you can sell to yourself, we eliminate all of that. Here, they've sold to themselves and they've made a profit. You're like, no way, we will eliminate that profit. Okay, so let's come and account for that. Is also something we take out from the reporting date line. Okay, so unrealized profit, let's do the math here. We can also work for that. So this is the depreciation. We can also do, in exam, you can do like much neater workings than we are doing here, right? So the provision for unrealized profit is our next thing to do. So we can work for that one here. So basically 5 million at a 20% profit margin with 40% of the goods remaining in stock. That's it. That's what we're doing here. Right? 40% of the goods are still in inventory, 5 million, margin of 20%. So 5 million by 20 by 40 gives me 400 from my end. So I'm going to put this 400 right here. You get, so that is it for my net assets. Okay. We can do our post-acquisition column now. So remember, this is always reporting minus acquisition. Please note, not acquisition minus reporting. So 15 minus 15 should be dash. 38 minus 20 should be 18. 6 minus 6 is 0. Minus 36 minus 36 is minus 36. You see, if you are done acquisition minus reporting, you get 0 minus minus. That becomes positive. So please be careful, okay? Then this is minus 400. Then we can sum everything here. So you get 3 columns, right? So we can do 15 plus 20 plus 6, right? Should give me 41 on my end. Then 15 plus 38 plus 6 minus 3.6 minus 4. That gave me 55,000. Then subtract the 2, you should get 14,000. When you add 18 minus 36 minus 400, you should also get the same 14,000. So this is my net asset, right? At this level. Of course, there are a few other transactions you could have here, but this is supposed to introduce us to the concept, right? So you can build on from here. You do the same net asset for the associates, okay? So let's go and open another net asset working. So this is for alpha. Let's come to beta. So the same concept, beta is associate, okay? So we have what? Acquisition date. You see, it's not difficult. Reporting date. And then we have post-acquisition. Right. So we go to the balance sheet again, and then we look at the equity section. So this is for the associate. So I said, whatever you see in the balance sheet is a reporting date, right? So this is 10,028. So share capital and then retained earnings. So we have reporting date, 10,028. And like I said, this will almost always be the same, unless the question tells you otherwise, okay? Retained earnings, mostly they'll give it to you. Let's go and see if they did. or we can figure it out anyways. So they bought 30% of Beta for 14 million. You see, at that date, retained earnings 15 million. Simple. So you bring the 15 million to your acquisition. You see, that is about, there's no transaction directly affecting the associates in their net assets. So we can close this here. This is dash. This should be 13. So this is 13. This is 38. And this is 25. So this is for Beta. Then we do the same net assets for the joint venture. Remember, I said you do it for subsidiary, associate, joint venture, if you have it in the question. All right. So our third guy is Gamma. Gamma is, let me write this well. Gamma is our joint venture. So same approach, acquisition date, reporting date, post-acquisition. Allow me to copy this guy so we move a little fast. So copy and then paste here. Okay, so we have our share capital and then retained earnings as well. So share capital, retained earnings. So back to the balance sheet. My share capital, you see 8 and 15. Those are reporting date numbers. They will not change. So 8, 15. This will not change. It's the same 8. All right, unless they tell you otherwise. Let's go to retained earnings. Now, this question did not tell us. Watch it carefully. They didn't tell us the retained earnings. This is the investment in Gamma. They didn't tell us retained earnings at acquisition. All they said was that Gamma Limited reported profit after tax of 6 million for the full year, which accrued evenly. So listen carefully. You don't know what the figure was at acquisition for retained earnings, but you are aware they made a profit of 6 million for that year. So this is simple. If it is 15 million today and they made 6 million for the full year and you bought them halfway into the year, do you agree you only enjoyed half of the 6 million? Oh, does it make sense? Let me take it again. If you come here, remember I mentioned here that 1st July 25 is when you got the joint venture. Okay. If they made a full year profit of 6 million, do you agree with me that half year of 6 million is 3 million? If that is the case, then you can work back to find your figure at acquisition, which is what? Essentially the 15 million minus the 6 million they made, half of it, 6 over 12, which is roughly 3 million. So 15 minus 3 should be 12 million. So technically, when you bought them, retained earnings was 12 million. But since you bought them, what you have earned, right, half of 6 million. Do you understand? Okay. So that is about it. So we can also do the math here. This is 20. This should be 23. So this should be 3. This is dash, and this is 3. So we are done with our net assets working. Quite simple. Then we go to our goodwill, our third key working. So working 3 is goodwill. Goodwill has a template that will never change, even at the advanced level. Worst case is we'll add a few things here and there, but it's not difficult. So goodwill, fair value of consideration. Then we add fair value of NCA at acquisition. Then we less fair value of net asset at acquisition. Simple, that is it. If there's impairment, you subtract, you are done. But because the consideration, this question is in 3 types, I'll just like create a subheading for each. I can say cash consideration, deferred consideration. In fact, there was even share for share. So let me bring that one next. So cash deferred, let's bring it next. Share exchange. And then contingent consideration. But ideally, it's just like one line, fair value of consideration, right? Then you come and add fair value of your NCI, non-controlling interest at acquisition. Then you would less fair value of net assets at acquisition. So what is my cash consideration? We put all of them together here. Let's go through them quickly. So yeah, share exchange is going to be 20 million. Don't forget. Okay. Deferred, we said 10 million over here. Contingent will be 4 million. It's fair value. And then the cash, they paid cash to buy them of 20 million here. So simple. So we have cash consideration of 20 million. Deferred, we said 10 million. Share exchange, another 20. Contingent, 4 million. Right? This is our total, which I think should give us 54, right? Okay. Then fair value of NCI at acquisition. Question told us that here, the fair value of the 20% NCI at acquisition was 12 million. So you pick that one and you put it here. 12 million. Then you less fair value of net asset acquisition. So just go to your net asset figure. Look at the acquisition column for the subsidiary. Look at the subtotal 41. Take that exact figure and bring it here. 41. This is goodwill. This is goodwill. So this will give you your goodwill at acquisition. We can even do a subtotal. Let's do it. Let's do a subtotal for the consideration. So it is neater to follow. So it means this is going to be 54. Okay. So our goodwill at acquisition date is given as 25. But we are told there's impairment. So with less impairment, with less goodwill, impairment. What did the question say? They told us that goodwill was impaired by 10% in 24 and another 10% in 25. That is 20% cumulative impairment. Okay. So it's going to be 20% of this 25. Which will give us 5 million. Therefore, goodwill at year end is 20 million. Okay. So this is my goodwill at year end, carrying amount. Now, let me add something here. Okay. Now, this is the standard template. It never changes. Fair value of consideration, what you pay to buy the subsidiary. You add fair value of NCI at acquisition. Then you less fair value of net asset at acquisition. You get your goodwill, you less your impairment. Now, I mentioned that we have full goodwill method and the proportion of net assets method. This is the full goodwill method. Proportion of net assets, this figure is going to be different. NCI at acquisition, you take the NCI percentage, and then you see this figure here. You multiply it by it. Take note. Proportion of net assets method. Very different. Okay. Because it's not full goodwill, you take the NCI's portion, percentage, multiply by the total, the 41 here, and that gives you your proportion of net assets. So that would have been different. Also, full goodwill method, we are going to share the impairment of goodwill between the parent and then the NCI. But if it was a proportion of net assets method, you don't share impairment. You only give everything to the parent. That's another approach, okay? But I don't want to complicate this for a beginner, which I'm sure some of you will be. So it's fine. Full goodwill, this is it, okay? All right. So this is our goodwill at the year end. Let's do our NCI. So our next working for should be our non-controlling interest. So for NCI, I'm going to start with the fair value of NCI at acquisition. You see this guy here? Whatever figure you have here, just pick the same thing. That becomes your first line of NCI. So some will say this first line, this second line of goodwill is first line of NCI, right? So fair value of NCI, the 12 million here. I'll put the same figure here. Then for NCI, we use what we call the roll forward method. So I'll add over here my NCI share of the post-acquisition movement, right? So we'll add NCI percentage or share of your post-acquisition reserves. If you remember in this question, we have a 20% NCI in the subsidiary. So you multiply this by what is the post-acquisition for the net asset? Can you see? Post-acquisition figure is what? 14 million. You have 20% of this movement. So this should give us 2.8. Then because it is a full goodwill method, you are going to give them their share of impairment. So you'd less NCI percentage of goodwill impairment. So NCI will take 20% of this impairment here of 5, right? Then you go and give the remaining 80% to the parent under retained earnings. Simple, right? Okay. So let me even reference. This came from working 2, net asset. This came from working 3, which is goodwill. So this is going to give us 1,000. Therefore, my NCI is 12.8 less. This is 14.8 minus 1,000, 13.8. Okay. So this is my non-controlling interest. Then I can work for my investment in associate, working 5. Okay. Now, for investment in associate, it is nothing complicated. It looks just like actually the joint venture, like I said, if you remember from the beginning, right? So I'm going to start with my investment at cost, mostly the consideration. So what did you pay to buy the associate? So where are you? Yes, so we bought them for cash of 14 million. Okay, so investment is 14 million. Then the logic follows just like the NCI. You add your share of their post-acquisition reserves. Okay, so you add parents' percentage of post-acquisition reserve. This is a 30% associate. So 30% of where is their net asset, if you remember? Associate, post-acquisition, total 13 million. You own 30% of that. Okay. So 30% of 13 million, also from working 2 net assets. 30 of 13 gives me 3.9. So I'm going to add the 2, and this will give me 17.9. Now here, let me pause. Let me be the first to say it, okay? when there is a sale from an associate to the parent, there are some who may do the adjustment in investment in associate. There are two possible treatments, right? But the standard one you see by most of the popular exam bodies, in fact, ACCA most of the time uses this approach I'm doing now. If you check your Kaplan, your BPP textbooks, those are like big established brands, right? They also do it. But remember, some people may come and adjust the provision for unrealized profit from the investment in associates. Just note that approach also exists. If you see it somewhere, it's not anything. Just know it's an alternative. But let's go with this. This is the more widely used one, okay? Although that other approach exists, right? Investment in associate. I'm saying this regarding this transaction here, that Beta sold goods to MSL at a markup, and there are 50% of the goods still in stock, right? Some may have adjusted it in this working, okay? All right, so just note that I am aware that treatment exists, but this is the more widely used one in most of the major publishing bodies, okay, for accountancy education, all right? Okay, so that is it. Then we can do our investment in joint venture, so working 6. So this associate, this is beta, okay? NCI is actually in alpha. So let's come and do working 6, which is my investment in joint venture. Oh, I can even do that one here. So working 6, okay. So my investment in the joint venture, this is gamma. If you remember, I said it's the same as if you can account for an associate, you can do a joint venture. It's the same principle. So it's going to be investment at cost plus parent share of post-acquisition net assets or reserves. That's it, right? So the same principle. Don't be scared of joint venture. It's the same as associates, technically, right? So investment at cost. What did we pay to buy our share in the joint venture? They said we bought 50% of the joint venture for cash of 10 million. You see? So I'll pick that 10 million and then I'll drop it here, right? Then I'm going to add parents' percentage of the post acquisition reserves. I have got a 50% stake in this guy. Okay, what is their net assets? This is it. Gamma, post acquisition, net assets, 3,000. You own half of that. You see? Simple, very, very, very easy. This should give you 1,005. And this is 11,500. This is my investment in joint venture. The next major working and perhaps like the most important of all is the parent retained earnings. That's where like a lot of the action is going to happen. Okay. So I'm going to work for consolidated retained earnings. So watch that one carefully. Working 7, consolidated retained earnings. This is for the parent. Now, always start with the parent retained earnings that you were given in the question. The parent retained earnings they gave you in the question. That's what you're always going to start with, right? Okay. So I'm going to say, all right, here, parents retained earnings. So going to the question, retained earnings of the parent is here, 61. Can you see? That is the parent retained earnings. So you pick that figure, 61, and then you drop it here. Are we good? Then you add the parent's percentage of the post-acquisition reserves of the entities. You see, so the parent has a stake in alpha, has a stake in beta, and has a stake in what? Gamma. In alpha, it is an 80% subsidiary. So we own 80% of their post-acquisition net assets. Where are you? You see, this is alpha's net assets, as you can see here, right? 80% of this post-acquisition 14 million is going to the parent. So 80 of 14 million. This should give us 11,200. Then we also have beta. Beta is the associate. If you remember, we have 30% of that associate. So we go to the associate net assets, post acquisition, and we pick the total there. You see? So let's go to the net assets. Where are you? Associate net asset post acquisition 13. So you own 30 of that 13, right? So 30 of 13. That should give me 3,900. All right. Okay. Then we do same for the joint venture. If you recall, the joint venture is a 50% one. For them, their net asset is here 3,000. You own 50% of that. So 50% of 3,000, of course, it's 1,005. Okay. Then, after you have done all of this, you now come and ask yourself, okay, which other transactions are remaining? You remember I mentioned some things will come to parent retained earnings from the beginning. First one is the share of goodwill impairment. Do you remember I told you that goodwill impairment, we give 20% to NCI. It is left with 80%. Who must take it? Parent retained earnings will take that 80%. Okay, so 80% of this 5,000 is going to go to parent retained earnings. So we would now say, okay, less parent's percentage of goodwill impairment. So parent will take 80% of the impairment of 5 million. This will give you 4,000. You will less this one. Right. Then also there are some other transactions that I said we're going to account for as well. Let's go and look for them. Let's pick all of them up. So I mentioned, look here, the unwinding on the deferred consideration. Do you remember I said we're going to debit retained earnings with 3,310. Debits to retained earnings to reduce it. Okay. Then we have another one here. This is the fair value loss on the contingent consideration revaluation. We'll debit retained earnings with what? 1,000. These two guys. Let's go and do those ones. We'll do the other one right after. So I'll come and say, okay. We'll also less unwinding discount on the deferred consideration. That is 3,310. Then we'll also less the revaluation loss on the contingent consideration. So that was 1,000. So we've accounted for like all the major transactions. right? Pretty much. But there's one more, which is the provision for unrealized profit. So let's go and check it out. See something. They said over here. Now, if you look at it carefully, beta, that is that we've accounted for this one already. Alpha selling to MSL. Alpha is a subsidiary. We've done that one already, right? Through the net assets. Okay. Now here the associate is selling to the parent. It's an upstream transaction. That's what we call it, right? So Beta sold goods to MSL for 4 million, markup of 25%. And 50% of the goods are still in inventory. You see? So I'm going to account for that here. Okay. It's a markup. So 25, yeah, percent. 50% are still in inventory. All right. So here I'm going to less what we call parents percentage of what? Beta provision for unrealized profit. So this is going to be 4,000. Yeah, because 4 million. Okay. Markup of 25. So 25 over 125. 50% of the goods are still in stock, but you own 30% of the associate. You see? So don't forget to bring that part out. Let's do the math. So 4 by 25 or 125 by 0.5 by 0.3. I got 120. So I'll take the 120 and subtract. Okay. That should be it. I think we've brought everything in. Let's do the math and see. So this is my retained earnings for the parent, right? So I'm going to start with 61 plus 11, 2 plus 3, 9 plus 1, 5 minus 4,000 minus 3, 3, 0 minus 1 minus 120. I got a total of 69,170 from my calculator. This is the retained earnings of the parent, consolidated retained earnings. Right, so we can go and prepare the group balance sheet. Let me show you how that will be done. Okay. All right. So here's a principle. All right. You basically add everything across for parent and subsidiary. Associates, you don't consolidate. You bring in one line item, investment in associates. Same for joint venture. So for beta and gamma, we will not consolidate their figures. We'll only bring in one line. Remember, we did them over here. Investment in joint venture, one figure. Investment in subsidiary. Where is that one? Sorry, associate, another one figure. So associate joint venture, one line item, one line item. Okay. All right. So we are going to, this is how I prepare group accounts. So you write the name of the parents you are preparing for. So in this case, you're preparing for the MSL Holdings Group. Then you write what you are preparing, consolidated statement of financial position. Then you write your year, right? This is as at 31st December 25. Okay. Then you go to the question. So you see we have our non-current assets, PP, our investment and all. So you can bring the same way it's written, your non-current assets We'll start with our property, plant, and equipment. So we've got parent. So parent is 85, subsidiary is 45. Please don't add the associate and the joint venture, I beg you. All right. So 85 and 45. There's a parent. Let me write it for you. Parent. I don't need to, but you get a point, right? That's a parent. Plus 45. This is a subsidiary's figure. Okay. Then there was a fair value adjustment, if you remember. So if you recall, yes, the plant was worth 6 million, depreciated by 36. So we'll take that one. So 6 plus 6 minus 36, right? Okay. Plus 6 minus 36. Okay. Then you might think that is all, but don't be quick to close this bracket. If you remember, we were told here, the joint operation. I told you that joint operation, you go and take your share of whatever is in the joint operation, come and add it to your own. So there's no working like joint venture. So you see here, they said the joint operation has a property, plant, equipment of 25 million. You own 40% of it. Please note, 40% is yours. Are we good? So I'm going to take 40% of that and bring it for you. So 40% of the 25 is yours, right? The PP of the joint operation. If you listen to my explanation at the beginning, so plus small bracket, 40% of what? The 25 is yours. Then you close your bracket. This got longer than I expected. So let me just move it down to this line here. Okay. So let me add 85 plus 45 plus 6 minus 36 plus 40% of 25. I got 142,400 as my PP. So I'll bring PP 142,400. All figures are in thousands, don't forget. At this point, you can go and bring your goodwill. So goodwill was from working 3. You just go and leave the figure and bring it here, right? So I think, let's look for it. Where are you? Good. There you are. Goodwill is what? 20,000. So you pick this guy, you see? Goodwill of 20. Then we will come here. So goodwill is 20. Then you can bring your investment in associate and investment in joint venture as one line items. So investment in associate, then investment in joint venture. So let's go and look for them. Associate was working 5, joint venture working. So 17,900 associate. Then our joint venture 11,500 working 6. Okay, let's go and pick them. So associate, this was working 5. This was working 6. So 17,900 and 11,500. Right, that is the logic. Okay. We will eliminate this guy here, the 49,000. The 49,000 is like investment that MSL has in all these entities. Now, the only time you're going to show investment on the face of the balance sheet is if we have external investment, that is investment outside the group. In this particular question, we can say that, oh, this kind of covers everything. Although the question said not everything had been accounted for. Don't forget, okay? They told us that MSL has not recorded this share issue. MSL has not recorded this liability or any finance costs, and they have not recorded the liability or the reassessment. So it means basically what is in the question was just some of the entries, not all of them. Okay, they had booked some, but not all, essentially, right? Okay, so let's take note of that. So what we have here is 49, right? Let me see here. I can actually prove to you how they got the 49. I'm sure you want to see it, right? Let me show you. See this 49 here? Remember they told us they have not booked some of the things. So the ones they have booked, let's do it. They have booked so let me show you cash of 20 million. That one, the question did not say it has not been booked. So there's cash of 20 million. This is for those who want to see what is going on. Cash of 20 million. They didn't say anything that has, this is the only element currently recorded in their investment line, meaning the share issue was not there. The deferred and contingent were both not there. So we'll bring the 20 million. Then let me show you another one. Beta, they bought them for 14 million. Okay, so associate 14 million. So associates was also bought for 14 million. Yeah. Who else did they buy? They said they bought the joint venture Gamma for 10 million. Okay. So joint venture was bought for 10 million. Then finally, the joint operation, they said they paid 5 million to acquire them. You see? So joint operation, 5 million. Ladies and gentlemen, add 20 plus 14 plus 10 plus 5 is 49. Do you understand? So that's where this is coming from. I didn't need to show you, but so that you understand. So whenever you do the math and you find out that you have intra-group transactions, or in this particular case, intra-group consideration, you have to eliminate it. So on the final balance sheet, I'm not going to show the 49 because it all relates to certain transactions that have to do with group parties. In a way, do you understand? So that will not show you. Let's go to the next part here. Okay, so we've done our non-current. We can find our total non-current if we want to. So let's do the subtotal here. So my total non-current assets. So 142,400, let me add them. Plus 20 plus 17.9 plus 11,500. I got 191,800. 191,800. Then we can come to our current assets. So current assets, first one is inventory. So inventory, you go to the balance sheet. I can clean this now, right? So inventory, please, as usual, don't come and add associate and joint venture. Please, you don't consolidate. So it's the parent plus what? The subsidiary, 24 plus 16. So parent 24, subsidiary 16. Then if you remember, we had some provision for unrealized profits. So let's go and bring those ones. Now, we had subsidiary. So if you check here, good. Subsidiary's net asset, there's 400. You see, provision for unrealized profit, we'll subtract it from this. Then the associate transaction too. If you remember, we took that one here of 120. Remember, I said some people will subtract the unrealized profit instead from inventory, the credit will go and hit the associate working to reduce it. Okay. But that is an alternative. But this is the one, like I said, you see in all those ACCA books. So just take note. In case you see another one somewhere, it's not wrong, right? It's open based on the examiner. Okay. But go with this in exam if you see it. Are we good? All right. So we'll take out 400. This is provision for unrealized profit. We'll take out another 120, also provision for unrealized profit. But don't forget, we have a joint operation. Okay? We have a joint operation where here they said a joint operation has inventory of 5 million. Don't forget, you own 40% of everything a joint operation has. So 40% of their inventory of 5 million is yours. Do you get? So you bring that guy here. 40% of 5 million is yours. So plus 40% of 5 million. So I can actually move this guy here. All right, so my inventory, let me do the math, 24 plus 16 minus 400 minus 120 plus 40% of 5 million. I'm getting a total of 41,480 as my inventory. So I'll put here 41,480. Okay. After inventory, what is next? I have got trade receivable. So that one to parent plus subsidiary. We don't consolidate associate. We don't do for joint venture, right? So parent of 18, sub of 11. Yeah. So trade receivables. So parent is 18. Subsidiary is 11. Okay. Then here we don't have, the joint operation did not have receivables, right? Yeah, they don't have. It's payables they have. But please don't forget, we have some intra-group transactions. So they said, watch here. Alpha Limited trade receivable include 1.5 million due from MSL. So in the receivables of the subsidiary, it's 1.5 they're expecting to get from MSL. Please, we are going to eliminate all intra-group transactions. So we'll take this one out. So the 1.5 million will be taken from receivables. And then when we get to payables, we also have to go and do some adjustment that I'll show you, right? But I'll show you how to split it up. Okay, so we'll take 1.5 million here minus 1.5. So this is the intra-group cancellation we are doing. So 18 plus 11 minus 1.5, okay. This is giving me 27,500. Then cash and cash equivalents. For that too, we have parent 8,000, sub 2,000, nothing for associate, nothing for joint venture. So parent 8, sub 2. We would have ended here, but there's cash in transit. You remember I mentioned it, right? So you come to your last line here. They said Alpha has 1.5 in their receivables as due from MSL, but MSL's payable shows 1 million. Why? Because MSL sent some 500,000 30 December. Year end was the next day. So by the time they did the cutoff, it hadn't hit the bank account yet. Alpha got the money 3rd January. So it is going to hang in there as cash in transit, which is an asset. You see, so we'll bring the 500 here. This is cash in transit. This 500 is cash in transit. Okay. So this is 8 plus 2, 10 plus 5. So 10, 5. Let's add and get our total assets. So we can start adding from the non-current side. Okay. So our non-current was 191,800. We can add 41,480. Then we add 27,500. Then we add 10,500. Total assets, I got a total of 271,280. I hope you are doing it alongside myself, so you get the same thing, I guess. So 271,280. That's it for total assets. Then we go to our equity and liability section. Equity and liabilities. So we're going to start with our share capital. So for share capital, please, we don't consolidate. So you come to the balance sheet, share capital here. Normal question, you'd have just picked the 75,000. However, don't forget the parent issued shares to acquire the subsidiary. So their share capital will go up. Okay. So I'll pick the 75,000 here. And because of the share exchange in this question, I'm going to add the share issuance. So if you remember, let's come here. Where are you? Yeah, share exchange. Can you see this guy here? The 20 million is going to appear, right? So let's come here. So this is the issue of shares. Take note, the new share issuance. This will give me 95 as my equity, okay? Then I'll bring my retained earnings. For retained earnings, please do not add across the face of the balance sheet. Why? Because you've actually worked for it. You see, we did retain earnings and got 69,170, working 7. So you pick that figure and drop it here. Do you understand? Yeah. So working 7, 69, 170. Then you bring your non-controlling interest, your NCI. Which was working 4. So you just go and pick the figure. What did we get for NCI? There you are. NCI was 13,800. Okay. So you bring this here. All right. Then after you have done all of this, we can go to, let's do our total equity. Okay. So equity is 95 plus 69, 170 plus 13,800. That's 177,970. Then we can bring our non-current liabilities. In the question, we've got non-current, long-term borrowings, parents 25, sub 10, no associate, no joint venture. So 25 plus 10, you're done. Long-term borrowings, okay. 25 and 10, giving you 35. Then the contingent consideration liability must be brought. Because don't forget, you're supposed to pay them. Okay. Contingent consideration liability. So that is it. Now I'm making it non-current because it said it's dependent on Alpha's future profit targets. Right. By December 25, the fair value was 5 million. We don't know when it's going to be paid. Right. So I'm making it non-current. Now use the fair value at year end. It's 5 million. The 4 million was used at acquisition date. But at year end, if they've given you the fair value of that contingent, use it. So the 5 million is what we're going to use. Remember, we even took the loss of 1 million toward retained earnings, right? So you bring the 5 million here, right? And to even prove to you the double entry, if you remember, we did this here and we debited retained earnings 1 million, credited the liability 1 million. This 1 million credit is what made the 4 million plus 1 to give us the 5 under liabilities right now. Do you get? Yeah. So that is it. Let's go to our current liabilities next. So we've got our current liabilities. So for our current liabilities, we're going to do what the question says. So we've got trade and other payables, parents 23, sub 11, no associates, no joint venture. Okay. So parent is 23, sub is 11. Let's do that. Trade and other payables. trade and other payables. Parent is 23. Sub is 11. But don't forget, intra-group transactions are to be eliminated because you cannot trade with yourself. You are the same person. You are now be made one. You cannot say you're trading and you owe yourself or whatever. So if you look here, they said, however, MSL's trade payables only show 1 million. We eliminate it. So we take out the 1 million to cancel it out. But it doesn't end there. The joint operation has a trade payables figure of 17.5 million. 40% of that is yours. You see? So you come and add 40% of that figure, which is what? Your 17.5 is yours. So we will move this here. Let's do the math and see what we get. So 23 plus 11 minus 1,000 plus 40% of 17.5. I got a total of 40,000 for my trade payables. So I'll put that here. Then the deferred consideration, don't forget, that one is supposed to be settled end of 25, and we are in 25, right? 2025. So that is what deferred, that's a current liability settled in less than 12 months. So deferred consideration liability. We did the math. The final amount payable was 13,310. Don't forget. You see, it was 13,310 to be paid at the end of 3 years. And we are at the end of that 3 years now. So it's due now. Do you understand? So although we used the 10 million for the initial calculation, we did the unwinding. If you remember, we went to reduce retained earnings by this, and we added 3,310 to the liability. That's what made the 10 to become 13. You understand? Yeah, that's why the double entry was important at the beginning. Let's go and try and balance it. So the moment of truth has arrived. We hope it balances. It should. I mean, this is too easy for me, right? But a total assets of 271,280. Let's see. So the liabilities and equity, we have 177,970 for my equity. Okay. Plus 35,000 for the long-term borrowings, plus 5,000 for contingent, plus 40,000 for trade and other payables, plus 13,310. I got 271,280, which balances here, right? So this is my total equity and liabilities. So, ladies and gentlemen, that is about it for this. Now, again, just to clarify a few things. Consolidation is not difficult. It requires a lot of practice. Now, I don't know the level of expertise or level of proficiency you may have in consolidation, but no problem. No matter what it is, if this video is one of your first, it should help you understand further. If you are an expert, it should help you bring the basics together. Now, what you need to now do after going through this is to look for transactions. When I say transactions, there are some small transactions. Maybe they'll tell you the parent sold to the associates. Or sometimes there can be sale of PPE. So parent can actually transfer PPE to another entity, property, plant, equipment, not just inventory, right? Yes. So, but this covers like the basics. To me, if you ask me, to be fair, this is like a very good foundation to start from. Of course, those of you doing corporate reporting or any advanced accounting paper, you would have complex groups, which is out of the scope of this particular video. But I do hope this has been of help to you, wherever you're watching from. If you found this helpful, you can share with your friends, your colleagues, those you study with, and all. So if you love this, this is MSL Business. My name is MSL, and I'll catch you probably on another one of our videos. So all the best of luck in your studies, and I really do hope this video makes an impact. God bless. Bye.